Welcome to the market update episode of cPROFIT and for the month June 2024. Let's start with global economy. See, just across the globe, the interest rates have been revised downwards after a longer period. Say like even actually this European Central Bank cut the rate by 0.25% and Bank of England tried just keeping its status quo. But if you look at Brazil, Chile, Peru, Sweden, including Colombia, all have just cut the interest rates. That's one a very important info because inflation and interest rates have just got a positive correlation. When the inflation goes down, the interest rate also tends to come down. And is China seeing this recovery shoot is a bigger question, right? So if you look at the China, to the biggest shock or surprise, the factory activity growth, it's 2-year high. And IMF also just projects that China will be just growing at the rate of 5%. And if you look at there are certain things actually just which we feel scared when you think of China. That is, the overcapacity in China can lead to just a lot of challenges. Say just you just look at the solar products, maybe just China, they dominate with 85 to 97%. In terms of batteries, they just dominate with 86% exposure across the globe, and 3/4 of the battery equipments are from China, and 50% of the footwear comes from China, and so on. So just if you just look at the US inflation, it could also just probably go up with the duty that they have just levied on the Chinese imports. And already just if you look at US national debt, it's a debt-ridden economy with more than 24 to 25 trillion dollar of debt, and it is likely to just hit 40 trillion dollar by 2026. That is, it is clearly just going to double in 8 years, which other way you can just say like in every 100 days the US debt could just go by $1 trillion. IMF projects the overall global growth in this way. In a nutshell, actually this global GDP is likely to grow at the rate of 3%, which is still just very attractive. China is likely to just grow in the range of 4 to 5%, and India is likely to grow in the range of 6.8% as per IMF projection. And how are we positioned globally is the question. Expectations are actually just, are we just landing somewhere? Is it no landing, soft landing, or hard landing? You look at the picture, maybe by April 2024, 54% projection is on hard landing. And actually just 36% is a feel that there is no landing. That means it can be stable as it is. So what next for just government of India is a $1 billion question. Maybe just before just getting into that one, maybe just let's talk about the coalition government. There are a lot of expectations from the coalition government, and again actually just a lot of negativity is also there across about the coalition. But what next for Indian government? Absolutely just right. Executive reforms which have the high impact like infrastructural spending and fiscal consolidation, R&D and innovation, the skill development will be the key focus. Probably right with the coalition in place, there are a few things which may get dragged. That is, there can be more negotiation needed. I won't say it may not happen. There can be more negotiation that is needed for farm reforms, Electricity Act, strategic investment, divestment, labor reforms, judicial reforms. Otherwise, right, if you look at the Q4 GDP, the growth rate has been hovering around 7.8%, and the overall FY24 growth is just pegged at 8.2%, which is very, very robust. And Standard & Poor's upgraded our rating to positive, and our CPI inflation has eased down a bit, maybe in the range of 4.83%, slightly lower. And the PMI index, everything is just showing a lot of thumbs up to just India. GST collections have been robust to just 1.73 lakh crores. And there has been a marginal slowdown on the domestic economic activity, probably because of the heat wave is what we feel. And India's share of the world exports are rising day by day. You look at the kind of maybe the blue line which talks about the world goods export share, and actually just what way we are just participating as an economy. And again, electronics and defense exports are also rising rapidly. And when you talk about defense exports, there is one more important info. The imports duty has been levied on the defense goods, and as such, actually, just Indian markets gave a thumbs up to the Indian defense oriented kind of stocks recently. The credit growth remains robust to support growth, because credit is the backbone. So the industry credit has been steadily growing, and the personal loan, the retail, the loans are also just growing. India tops the emerging markets, tops the number one in the emerging markets tracker. Say just like if you look at the India's composite index score, it's been in the range of 83, and the real GDP growth is 8.4%, which is too very brilliant. And then the purchase managers index, which talks about the productivity, which is hovering around 58.8. Export growth, see, we are pairing exceptionally well across all parameters, say like export growth, CPI inflation, that is a consumer price inflation, and the import cover, how many number of months we do have, and the exchange rate movement. You look at everything, we are doing exceptionally well. And that is one of the reason, as I said earlier, the Standard & Poor actually just gave India's outlook as positive, and there is even among the emerging market tracker or in the benchmark, our exposure keeps going up and up. So the real GDP growth is likely to be in this range. Maybe even the forecasted GDP growth is likely to be in the range of 7%. Unemployment rate is slowly just coming down. The current account deficit is just always hovering in the range of 1.3 to 1.7. As you know already, most of our exports are just pegged to INR. So that probably just brings down most of the burden. And then debt to GDP, maybe just we have a subsequent very interesting slide. Maybe we'll talk about it as to just how is India's debt to GDP vis-a-vis other global economies. So the IT and finance jobs is normally just IT as a sector used to hire 1.5 lakh to 2 lakh people, the men force in India, but it has come down slightly. Not only it has come down, even actually there's 67,000 employees who got laid off or not replaced so far. This is definitely one cause of concern, and again we will be talking about AI, artificial intelligence, and its impact in India. Maybe before going to that one. So you look at the BSE market cap. Let us just pat it on the shoulder and say that we have done very well in markets, because market cap has just hit $5 trillion for the very first time in India. And maybe the return on equities have just gone up sizably. The corporate debt at a higher, that is 15-year low level. That means the corporates are just heavily betting on working a lot and just increasing their weightage in the markets, and thereby the market capitalization grows, and vis-a-vis just the borrowings have been 15-year low, which is a very, very positive sign. Again, foreign portfolio investors, their flows have been very erratic. If you look at last year, just by November 2023 is what they started pumping in money to India, whereas the entire 2023, only your domestic companies, the domestic institutional investors and the retail individuals, they invested heavily in the markets as well. So look at the market cap to GDP ratio. We are all-time high. That definitely says that markets are expensive here. See, just 132 is all-time high. Maybe how do you just look at it in the sense, just go to maybe just during the COVID period, it was hovering at around 80. The market cap to GDP has been 80. On an average, it's been 80. Today, we are at 132, which is seriously high. And what are the valuations? What are the valuation levels now? Are we at a premium to the historical averages? Yes, we are definitely. You look at the large cap. You look at BSE 500 index, and then 1 to 100 is large cap. We say we are running at a premium by 4% to the historic average. And then the 101 to 250, which we call as mid cap, we are running at a premium by 29% to the historic average. And the small cap, we are running at a premium by 27% to the historic average. So, are we prone for volatility? Yes, of course. One is a coalition, as we know, and the US Fed. US is likely to just maybe reduce the rates twice in this year. But if you just go look at the US Fed, 3 veterans in the board have spoken in a different way. One has just informed that there can be no rate hike. One said just 3 rate hikes are expected. One said 0.25%, that is only 1 rate cut. in US. So as I said, just as China will just pose bit of challenges to the US economy, and as such we don't know whether more rate cuts would be there, but 1 or 2 rate cuts in US Fed is likely to be there, is what most of the veterans just expect. So that will definitely be having an impact on Indian markets as well. So be ready for the volatility and the energy prices, and the consumption as a sector will recover. Geopolitical tensions are going to be there, as you know, couple of wars are running, and that we'll have to keep it in mind, and the global recession undoubtedly, and then the rate cuts may get delayed. As I said, the US itself may not just cut rates very robustly, and then actually just the probably just it can also just give us an idea as to what kind of asset class we'll have to look at. Probably we have to just allocate. Maybe this RBI has played very well, and they play this melody just very well in India. See, just they have managed inflation, growth, rupee and volatility, or rupee and liquidity very well. And Indian bonds remain under allocated by not only foreign investors. I would say if you look at the foreign investors, their allocation to Indian bond market is not even 2%. Even in as average Indian goes very aggressively looking at the current growth trajectory of India, everybody bets on equity. Probably it can be a time to just invest a bit in bonds as well. It is good to just look at long-term bond like the Dynamic and other one, which heavily bet on government securities, and then safer corporate portfolios as well. Gold still looks very attractive. Whenever there is a crisis, gold will definitely do well, and maybe just now we have another 6 months to 8 months for things to settle down. As you know, more than 70 countries are getting into election in this year. So if you look at as a whole, gold share of global international reserve is has jumped to just 17.6%. And silver is nevertheless, we cannot underestimate silver as asset class because it has got industrial usage as well. And I could also just foresee silver jewelry shops across the country. Maybe just silver catches up with gold and the ratio narrows. And then let me just jump into a couple of research views at this point of time about India. Morgan Stanley's view, Morgan Stanley expects around 15.3% of CAGR investment in infrastructure in India, and maybe just they feel like this will definitely lift the investment rate, leading to a sustainable period of high productivity growth in India. And probably just 4 major macro implications would be there is what they feel. That means a profit boom via augmented capex, that is a capacity expansion, and improved macro stability, greater efficiency in terms of productivity, and more sustained growth. Again, Bank of America is nevertheless, they have also projected India in a much elite way, and they say just India is one of the fastest growing economy. Probably just this is a comparison which I told earlier, the expected GDP growth for the calendar year 2024-25. Look at, we are leading, we are number 1, and the projection is easily closer to just around 6% by even BOFA. And look at the other economies, and China is also pegged closer to just around 5%, and globally just we are likely to grow in the range of 3%. And again they say just this is a very interesting slide which came out of maybe BOFA's research, which says that the households in India, they deploy 7% of their savings to equities now. The share of deposits and cash is decreasing day by day. That's a very interesting kind of a slide, I would say. And probably the time has just come for you to just rejig the portfolio, and you can give slightly a better weightage to large cap if you want to stay put in equity, or marginally underweight to just mid caps and underweight to small cap given the valuations. But it is big time. You just rejig, revamp your portfolio, meet your advisor, and just ensure you have a balanced portfolio based on your investment horizon and the goals that you have in mind. Thank you so much, and just kindly just follow us on our media pages.